Good morning. This is Jim Colburn of Commodity Research Group. I'm with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check out our website, commodityresearchgroup.com, where we post our podcasts and blog. We would like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer or to endorse any particular trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone, especially those not intended to listen. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivatives. Today is March 13th. Good morning, Andy.
Good morning, Jim.
Let's talk about these oil markets. Let's get right into it. I want to start with the EIA. Came out with their monthly short-term energy outlook yesterday, and they trimmed world consumption by 60,000 barrels for this year and 80,000 for next year. What's your take on that?
Well, I think those are really minor. 60,000 barrels a day versus 100 million is really not a big deal. I think it's important that so far we're going to learn from the IEA and OPEC tomorrow and Friday where their numbers come in, but we really haven't seen these demand numbers being radically revised downward, given all the hand-wringing that was in the market over the last year about the economic slowdown, and in fact, the U.S. numbers are so far have been coming in pretty good.
Yeah, I mean they're showing a growth of about 1.45 million barrels of growth for 2019, and that's a pretty good number.
Yeah,
globally.
Yeah.
Sorry, yeah.
Yeah, I mean the U.S. I think they have up like 200,000. I think China, they have up, is it 400,000?
Yeah, it's
up 200.
Where is China? Yeah, China's up as well. Yeah, the sort of the obligatory up 470,000 for China this year and 480 for next year.
Right.
Yes. So yeah, I think that's a story that we've heard that and there's also the EIA had a piece of the correlation numbers for the price of crude oil versus the S&P 500, which of course is this demand story going on. So it's the correlation is it's getting up there. I think it's around 30, 38, something like that. The 30-day correlation is up to 38. So that's that's sort of what we're hearing from the news. But what you're saying is that we're not actually seeing any really sharp decline in demand.
Not yet. Of course, that can certainly change. The market is awaiting what happens with Brexit and the trade talks, et cetera, et cetera. It's interesting talking about these correlations that even though we haven't seen the actual numbers come off, the market has a tendency to really get hit when there's bad news on the macro front.
Right.
You're like, it's seemingly we're automatically down $1, with any bad news. And I think even though the fundamentals have really, they've really improved, obviously, given the price action since late December, you still have this, it's a sort of it's a bear trap almost.
Yeah.
Buying it, you're looking good, you're happy, and then, phew, you're down $1. Maybe, Jim, maybe that's one of the reasons why we haven't seen all that much speculative action in this market.
That people just got caught on the wrong side.
Yeah.
Because coming out of the OPEC meeting last year, we thought that the market would stabilize, and I guess there was the market reacted to the overhang that was out there, and the stock market decline. And there might have been a couple of traders that were long, hedgers too, that had to liquidate. There was a couple stories in there. So obviously it was for 2020 hindsight, it was overdone on the downside. But
yeah, way overdone on the downside. But even now, you get some really bad trading days, where the market just gets whacked.
Yeah, and you certainly don't want to watch the financial news, because it's an oh my God world. I mean, it's everything is, it's the worst day for crude in the last 2 weeks. You can say, right? And also one of the bias for equities is that a day up is good and a day down is bad. But for commodities, you can easily short as you can go long. So, if you're saying oil had its best 2 months in a long time, how do they know I'm long oil?
That's exactly that's a great point.
Anyway, let's look at the IEA also trimmed world supply by
The EIA.
I'm sorry, get them mixed up. The Energy Information Agency, the U.S. DOE's stats arm, showed a decline of world supply for this year of 320,000. They trimmed their forecast this month from last month by 320,000 barrels a day. So that's coming out of the U.S. and OPEC. And what's your take on that?
Well, the U.S. number was I think a trim of, what was it, 100 a day?
Yeah.
They still have it up like around 1.4 million barrels a day. Maybe some of that, I think, the revision downward, there was a lot of, there was a story I think it was the Wall Street Journal about the parent-child wells not coming, hurting the parent production. Maybe they put that in their models. Rig counts have been down. Maybe that was in their that's in the models. But we're still growing pretty. There's still pretty good growth. And as we'll talk about later, we're really going to need that. We're going to need U.S. producers to come through when you start looking at what the what the balances are going forward. So we certainly need our production. The other amazing thing is that the EIA predicted that we're going to be a net petroleum exporter by, I think it was fourth quarter of 2020.
Yes.
Exactly. Which I think for you and me, Jim, is just it's just unbelievable.
It's unbelievable. Yeah. I mean, some people, you listen to some of the politicians, they think it's already happening, but it may have happened for a month or so last year or something. But
right.
On a regular basis, that, like you said, the EIA is looking for fourth quarter 2020, where we become net exporters of crude oil and petroleum products.
Now, in the same report, in the short-term energy outlook, they did show crude stocks growing quite a bit in second quarter. But you know what? Yesterday or today, the EIA came out and the weeklies came out with a draw of 3.8, owing to smaller net imports. Imports were down, exports were okay, and they revised production down. So if you look at days supply on U.S. crude, which is stocks divided by demand, it's only 28.2 days versus a 4-year average of 30 days. So we probably will build stocks coming up as production grows, but we're going to start from a lower level. So, I thought this week's report was pretty bullish. I thought the EIA report, the short-term energy outlook, was, sort of neutral for U.S. balances.
So they did trim their inventories, as as you mentioned. The rig count also they mentioned in their monthly. Let's focus in on OPEC production, Andy. I mean, you after the meeting, you thought that Saudis would do exactly what they said. Now, it took a little while for the market to catch up to that.
Right.
Right. But what do you see? Let's talk about the Saudis first of all. What do you think is going through their what's their policy going forward, do you think?
That's a great question, Jim.
Yeah, as always. Yeah.
I'm sure that the entire oil market would love the answer to that one.
Yeah. Well, what's your take on
it? they went from, they increased production in fourth quarter at the behest of the Trump administration, who was telling them that they were going to force the Iranians to go down to zero on exports. They quickly had to do it about face because they realized, the Trump administration granted waivers, so there was going to be a global surplus owing to their increase in November production, and then it took them a few months to get down. They said they were going to get down to 10 million, and then even lower, 9.7, 9.8, by March. And I think when the March numbers come in, that's around. They'll probably be around 9.8, which is down 1.2 from November. So the big question, obviously, is today at Sierra Week, Brian Hook, who is working at State Department, I guess he's Assistant Secretary of State, or I actually don't know his title, but he's the one working on the Iranian sanctions, said that the U.S. Wants to see Iranian exports go to zero. So if it does, right now it's about 1.3. I don't think it'll ever go to zero, Jim.
Right.
But let's say it goes down another 500,000 to 700.
Yeah.
What are the Saudis going to do? Are they going
Right.
to increase? I don't know. They're not giving a lot of indication that they want to.
Yeah, it gives me time to bring up, kind of where I spend some of my time in the world of options, because if you think about the next OPEC meeting is April 17th, April 16th. The May options go off the board the day before the meeting takes place, and then they go off the 16th. So, and then the sanctions decision will be made early May. Is it May 4th, maybe May 5th, something like that?
Yeah, I think it's around May 4th.
Yeah. So June options are alive for that. So if you look at the volatility difference, June is over May. In fact, June through DECE, it's kind of the vol curve is in a bit of contango. So the market, even though I mentioned vols have come down sharply this year, the rest of the option market is saying this is maybe the calm before the storm. So we'll keep an eye on that. Also, the other thing is the option volume is it's like 40% below last year at this time year to date, and vols coming into this year were up in the 50s. Now they're below 30. So that's yeah. So there's I'm trying to figure out if we've actually lost some permanent volume from the moves of last year. We had a wild natural gas market that blew out some option sellers. We had this extended move down in crude oil, and it looks like we lost at least maybe some speculative activity, but maybe even hedgers are worried about or just not confident in where to place hedges as well.
I think you're right. I mean, certainly the press was filled with a lot of big funds that closed last year in commodities. As I don't think anybody had that move down to 42.
No.
Most of us were bullish, including you and me.
Yeah.
And, again, a lot of it came down to a change in what the geopolitics were in terms of where Iran came in, as well as the overriding macro fears really tended to exacerbate the move down. Trade talks, the Fed, et cetera, et cetera. So, I think you're right. I think there probably is a lot less spec activity.
Yeah. So last year at this time we were talking about the tightness that was going to come in the fourth quarter. So you had all this concentration of people buying $100 calls in WTI and in Brent, and open interest got up to like 50,000 on each, something like that. And we don't have anything over 30,000 in open interest. And when I look at the the top 10 calls, the DECE 2020 and the DECE 2019 $100 calls are still in the top 10, and I don't think they've been they haven't traded significantly since maybe a couple quarters ago. So it just tells you there's not a lot going on in the world of options. I mean, it's still over 100,000 contracts a day, but that's nothing compared to
nothing compared to
what's done.
what
But
it was.
that may change. I mean, like we have some really potentially market moving events coming up, the OPEC meeting and the sanctions decision. So you would think.
Let's get back to OPEC because
Yes.
there's, look what's going on. Even Libya in December lost their biggest field. It's coming back now, thankfully, because the market's going to need that. Actually, it doesn't really need it because it's sweet crude. We lost Venezuela is just, continuing to cycle down. Now there are blackouts, which means they can't produce. Storage is filling up. They can't find ships. So, the 1 million, they're producing like 1.1 million barrels a day. That could easily go down another 200,000-400,000 barrels a day. So, the Libyan barrels will replace that. But again, the Libyan barrels are sweet. We really need sour crude.
Right. And just an aside, I had heard a podcast like in the middle of last year, was it, where some Venezuelans were crypto mining, and they were exchanging the cryptocurrency for food out of Miami. And that's because the power prices were subsidized very low, but they were intermittent. And now with these blackouts and also the price of crypto coins is way down. I'm not sure that apparently the police found out about it and didn't shut them down. They just asked they just put a sort of a local tax on them, and but I'm sure that's not working anymore. Doesn't work economically anymore either. But
another OPEC producer to watch, of course, is Nigeria, where the Delta Avengers, which is a terrorist group, threatened to destroy some production facilities if the current president was reelected, and he was. So that's yet another one to watch. So obviously there's a lot going on in OPEC. In terms of the deal, OPEC, thanks to the Saudis, has pretty much adhered to the deal, and then of course there's the geopolitical cutbacks. So OPEC production since November, is down like 1.5 million barrels a day.
Amazing.
It really is amazing, and Jim, I like to look at those call on OPEC crude.
Yes.
And right now, it looks like call on OPEC crude, or the demand for OPEC crude for the first half of this year is very close to where their production is right now, plus or minus a couple of 100,000 barrels a day. So the market looks very tightly balanced.
Yeah, I mean, a lot of times when the markets are balanced, you see a decline in market volatility, and then when it's we're producing more than we need is when the markets get really riled. With all that's going on, we could actually see increased volatility in a balanced market because it's maybe the Saudis overshoot, or and maybe a lot of it has to do with U.S. policy too. But there's a lot going. It might not be counter. You might not get one bullish surprise and then one bearish surprise. It might be all in one way. But we'll have to see how that unfolds. Let's. Should we talk about gasoline now?
Gasoline, yeah.
Because
story.
Because gasoline cracks have improved. What's going on there?
Dramatically improved because
first of all, U.S. here.
First of all, gasoline, looked like I think in our, one of our winter, either December or January monthlies or February, I think I was probably saying, "Oh my God, gasoline really looks it looks like it could go right down the tubes." And what happened is that these getting out of turnarounds is taking forever. So production for gasoline is down. Demand is okay, and as a result, we're drawing stocks. Pad 1 is tightened up. It's backwardated. Certainly, the cracks have improved. The refinery cracks, real crack, besides the NYMEX cracks, the real refinery margins are, made a big rally from like the January lows. They're beginning to stagnate here, but gasoline in days supply is at 27 and a half, or like versus the 4-year average of 26.8. So that's half a day. It was like, I don't know, 3-4 days above a few months ago.
Right.
So gasoline is definitely improving globally. The big question is, where are we going on demand? I think for 2019, demand will grow globally for gasoline. It's not going to rip roar, but it should be growing.
In the the runs were like 16 million today. They came out, right? And then what do you think they're? I mean, are they going to continue?
Should be like 16.4, 16.5 by now.
Wow.
So where we've had problems, extended turnarounds, weather-related stuff, refinery issues. Exports have been running pretty good, and as I said, demand has been okay. It looks like it may even be growing over last year so far.
Yeah, amazingly. So
another hand-wringing thing, for all, the electric vehicle obviously is a major factor, but it's not going to be 2019, I don't think, or probably 2020.
Right, it's not yet.
Not yet.
But ethanol, maybe.
Yeah, ethanol, maybe.
Yeah.
Yeah, ethanol, maybe. And diesel. Just looking at diesel, that seems to have stabilized around 136 million barrels. The day supply is 34 and a half versus a 4-year average of 36.6. 2 days lower, so not. That was much lower late last year and early this. Diesel is going to be about the economy and the IMO 2020, and that's a whole nother podcast that we're not going to talk about right now.
Right. Just backing up a little bit, let's talk about WTI prices. Cushing. There's been a couple of one pipeline that's been switched from using natural gas to take crude oil out of Midland into Cushing. And there's been another pipeline, same thing happened. Natural gas was used for NGL, now used for crude oil into the Gulf Coast from Midland. What's that? Is that affecting prices? Are there other things going on?
No, it's definitely affecting prices because, there's a couple of things going on. One is the sour crude is just tough to find, and we're seeing some of these sour barrels, really command big premiums. But even the sweet, like LLS, is way over Cushing. Cushing inventories have grown pretty dramatically. Because turnarounds in PADD 2 have been prolonged. So as a result, we're seeing Cushing stocks build. So you have Mid-Continent weak, and the ports pretty strong because of export demand. I think we hit a record at some point in the last few weeks, and we're going to continue to increase on exports. At the same time, again, the refiners are going to have to figure out, okay, the margins now, sour crude is so expensive that the margins aren't that good. They may end up, running more sweet. And, those differentials will weaken. So, it's going to be a pretty interesting, it's always interesting, but it's pretty interesting to see what they're going to do.
Yeah.
What they're going to run and what crudes are going to be in demand.
So let's talk about price movement going forward. We had sharp decline, as you mentioned, late last year. I think it was December 24th. Market rallied. Let's talk about crude oil. What do you think from here, given what's ahead?
Yeah, I think there's still some upside. I mean, we had been talking about potential for $60 WTI. Maybe not in December when it was making new lows, but I think in some of the monthlies, and certainly in our monthly report. So we're not that far from it. We're not that far from it now. A lot of the balances are going to depend on, as we said, it's a geopolitical market. So we're obviously going to be following what's going on with the waivers, what the Saudis do. The market could go significantly higher.
Right.
If production doesn't, let's say we don't cut, U.S. production doesn't come through, and the Saudis keep at like 9.6, 9.8. We also Brazil is supposed to grow. Non-OPEC production is supposed to grow a lot this year, owing mostly to us and Brazil.
Right.
So we'll see if Brazil, comes through. So I think that, I sort of still like the upside, but there's, as I mentioned earlier, there are those bear traps there, Jim.
Yeah.
They're all over the place.
Yeah.
So it's a tough, I like it higher, but, you got to be nimble.
Got to be nimble. Okay. So what about, you talked about gasoline prices. What about going forward? You think they're still going to do well? I mean, they're going to hang in?
Yeah, I think we
Or is
may be
this,
seeing, this is a nice preseason rally. I because runs are going to go up. They're going to go up from 16 to 17 over 17, 2, 3, 4, and we'll make more gasoline. Demand will go up, but a little, we may be seeing a nice spring rally right here, and diesel. If the economy hangs together, that too could have some upside, but you start getting some you start getting some bad news on the trade talks, or we slow further globally. Diesel could be a factor, but I mean, could be diesel could be under some pressure. But again, we will talk more about this IMO 2020, but
right.
that's like another outlier for diesel.
Yes.
So all in all, I don't know about diesel.
Right. Right. There's another wild card.
Yeah.
Okay. Well, anything else you want to add to what we talked about today? What are we missing here? I think we covered it pretty
I
well.
think we covered it pretty well. I do want to add that if you're interested in getting our monthly report, you can find us on go to our website, which is brand new. It's really good. Jim posts some great stuff on there every day. www.commodityresearchgroup.com. Or if you want to get a hold of me, Lebow, ALEBOW, at commodityresearchgroup.com.
Great. Thanks, Andy. Talk to you next month.
Thank you, Jim.